share repurchase, a scenario which could have happened to any of us or almost all of us. You gave something out or you sold something only to realize almost immediately that you actually are in need of that particular thing, and you realize that it's even scarce in the market, and the quality that you gave out actually is no longer in the market. You feel like buying back that precious commodity that you just gave out, right? So sometimes it's the case of share repurchase to organization, why we are asking why firms, why companies buy back their own shares. Having established that, share repurchase is a way of rewarding shareholders. It's a way of rewarding shareholders as against giving them dividend, cash dividend. Having established that, why? That is the question we want to resolve. Primarily, first of all, among so many other reasons, is an organization's manager or management, the board, tries to influence the market price of their share and fulfilling the law of supply and demand. When they buy back their shares, it's the commodity is no longer in huge circulation in the market, and it becomes a bit scarce. Likewise, the price goes up. That is law of supply and demand. So they buy back because they felt it is undervalued. So undervalued shares could be purchased, buyback by the owner, that is the company. And when that happens, it signals actually to the market that something is about to happen. The organization is even buying back its own share. That means those shares are worth more or more precious than we've been pricing it. Then people quickly begin to buy more too. And as they continue to buy the scarce commodity in the market, the price will skyrocket. So that is one of the reasons an organization will buy back its share when they are trying to increase the value of their market price of the share. That is one of the reasons. Another reason is for tax benefits. For tax purposes, for tax benefits, an organization can decide to actually buy back its share. And when they do that, the bottom line, that is the profit, is a bit eroded, and they expend it into share repurchase, thereby saving what should have gone into the tax needs. So that is another reason an organization will buy back its own share. Another reason an organization will buy its own share is to reduce the impact of dilution. Share dilution, that is how many people's hand or institutional or corporate organization, how many people have our shares. When an organization tries to control the distribution of the share and not to dilute it, not everybody should be buying the shares and the like. When they try to control the dilution of the share and minimize the number of shareholders they have, they try to buy back their whole share, that is taking it back into possession. Another reason that an organization will buy back its share is to increase control, which goes simultaneously in line with reduction in dilution. So when an organization wants to increase the control over its own share, it buys it back from the market. Now, let's say we have three major shareholders and some other minority shareholders. Now, when we buy back from the market generally, now the influence maybe from the three major shareholders, a bit of the shares were taken from them. Likewise, from the minority, that is individual that buys maybe 1,000 units, 2,000 units, and the like. Some sold and the organization buy back. So the organization has in its own personal portfolio its own shares too now, which is it has control and voting power on. I hope we get that. So that is another reason an organization will buy back its own share. Another reason an organization will buy back its share is to avoid or to minimize and control hostile takeover. Hostile takeover. What is hostile takeover? Is a situation in which an organization just wake up one day to realize that another manager has actually taken over the organization as a result of larger amount of shares being purchased. Should we say secretly? But somehow without the organization or the managers get to know that somebody is accumulating their shares somewhere, they just wake up one morning to observe that there is another shareholder in the market that actually has huge control, and the person just shows up. For that not to happen, they buy back their shares, because when an organization buy back its share, nobody can buy it without consulting the organization. So it minimizes the impact of strategic takeover of the organization. So these are some of the reasons an organization will buy back its own share. I'm going to quickly recap. And before we recap, please, if you are just joining us, please subscribe to GJ's Associate, like us, click notification, click all, and if there are any reason, please comment and engage us. It is very important also that we discuss that there are so many reasons organization will buy back its shares, and it is important for shareholders to be very careful and cautious to understand, especially investors rather than shareholders should be very careful to understand, first of all, why the organization buys back its shares before the sentiment takes over and they begin to buy. Because sometimes it could be artificially to boost the stock price, like the first mention that I mentioned to us, or to benefit the executive, maybe compensation, stock-based compensation. So they have to buy back so that they can have something to give to their executives, maybe the chairman, the CFO, the CEO, and the like, which organization has stock-based arrangement for their compensation. So also it is important for investor to be very careful to consider the motivation behind the stock buyback program that the organization has just embarked on. It is very important that we establish that. So what we've just touched on is that undervaluation to signal to the market that our share price actually worth more than what they've been buying. We try to buy it back from the market and make it to become more scarce in the market. Then the price goes up, fulfilling the law of supply and demand. For tax benefits, we ensure that we expand, we buy back, so that we take some things, some figures away from the tax net. Another one is to reduce dilution, to reduce in how many people's hands do we have our shares. Also to increase the control that we have over our organization. The more shares we have as an organization to ourselves, the better. And even the earning per share will go up, because we have less of the number of shares that are yet to be subscribed to. We have the control of it to access. Also, hostile takeover is almost daily experience in the business world, and an organization that has in its own personal portfolio its own stock has minimized and reduced and defended itself against hostile takeover. When we will be looking at another great topic and great subtopic in finance and accounting. My name is Gbenga Olatunji FCA. For those that are just joining us, like, comment, and subscribe. We are value to life. From G James Associate Channel, we are value to your businesses.